All right, let's talk about how people create wealth, especially in 2026, and how you can too by developing things from the ground up. Since mankind was created, to create real wealth, you have to create something from the ground up, right? So you could do sales, you could do arbitrage, but really to create massive wealth, you have to develop. So either you create a product or you create, the next vacuum cleaner or real estate, which is I believe the simplest way to do it. Anyone can do it. You don't need experience to develop real estate from the ground up. So it's very simple in essence, right? You just buy land and then you hire a contractor. Now there's a lot of, there's a learning curve to it. You need to understand the financing. You need to understand how to vet the correct contractors, make sure they're doing the job correctly, and the construction draws, the financing, etc. But really, if you can get over that knowledge gap, you can create 6 figures of profit / equity within a year or less than a year. The way I do it is I buy permit ready land. Okay, so with permit ready land, you're able to save a lot of time. Normally for me, I save around 8 months if I buy land that's already permit ready. So what does that mean? That means it's shovel ready. Okay, so we can start digging the dirt upon possession. So there's a couple of things you guys need to understand with developing real estate. It is capital intensive. However, it is generally pretty safe. I'll give you a couple reasons why. So number one, if you buy land correctly in the good location, even if you don't want to go ahead with the build, you can normally sell it for a profit without doing anything. Either you let time pass or you just do the drawings or the permit, and boom, you just created value. Now the most value is created, the most profit you're gonna make is if you go ahead and finish the build, of course. So the best thing to do is to finish the build. I just love the mountains out here. I'm just in Utah and I'm able to travel. I've been traveling for the past couple months while my developments are going. And the reason why I can do that is because we have project managers, right? Project managers included in the construction budget. So we have a construction budget. In that line item, you can actually give yourself a salary too. It's called a developer fee. I'm the developer, and then I have a project manager. I pay them per project. It's up to you how much you want to pay them. Usually 60, 80,000, 100,000, depends. It depends how many projects you have. So for yourself, you can pay yourself a developer fee, normally like 100,000. So during the build, during the draws, the construction draws, actually let's go this way, you can actually you can get paid. So you don't have to wait for your house or for the building to be finished before you see profit. You can actually make profit during the build itself. Now let's go back to what I was saying. I got distracted. So when you develop real estate, you're creating 6 figures worth of value. Okay, the type of buildings I'm doing, we're creating mid 6 figures. So normally around $500,000 of profit / equity once it's done. So it's normally it's a 7,000 square feet, 8 units, multi-family townhouse. So obviously it's brand new, so it's super beautiful, 9-foot ceilings, quartz countertop, and so your buyer pool or your renters are going to be very high quality. So that's another thing. So if I were to break down development to you, so you understand, basically what you do is you buy land and then you get it to a certain stage so that the bank will start giving you what's called construction draws. Okay, so each draw, they give the money after you finish a certain milestone. So when you build something, first you do the foundation. Well, first, if there's an old house, you have to demolish the old house. Then you do the foundation and then lock up, and then the MEPs, mechanical engineering plumbing, and then you're at the finishing stage, and then you get the occupancy permit. So basically, you need to, it depends on some banks what they want to see, but some banks want to see you at lockup stage. So lockup means you're at framing, so the foundation's done and you're at the framing stage. So normally this is, you've already spent like, I'd say around $500,000 on top of buying the land. Okay, so it is very capital intensive, but you can raise the capital, and like I mentioned, it's a very safe investment because it is, you have ownership of the land, so you could sell the land anytime. But also number two is you get what's called an as if complete appraisal. So meaning even before the build is done, you get that appraisal. You need it anyways. The bank needs to see this before they give you construction draws. This as if complete appraisal is it's like an 80-page document. It costs like $4,000. So it's a pretty serious document. It tells you based on the projected rents what this building will be worth based on the cap rate in that area. Okay, so they're evaluating it based on your drawings. So you're gonna submit your drawings to the appraiser. They're gonna do a market analysis to see what the market rents would be when it's done, and then they divide it by the cap rate in your area, and boom, there you go, that's the value. So on average, your value of this appraisal is always more than what your cost is. Okay, it makes sense. It's not, so it's like when you renovate a house. Have you ever renovated a house and the value went down? That never happens, right? If you buy a house and you renovate it, the value goes up, right? All the time, obviously. So if you put in new cabinets, you put in new flooring, the value goes up. Same exact thing with development, but instead of renovating, you're building on the dirt, right? So that's how it works. Now let's go back to what it looks like when it's done. So again, you create normally around $500,000 worth of equity. So you could choose to refinance off that new value, and that's how you're able to pull out all your initial investment. Okay, so you actually build that, and that's how you can scale super fast with developing real estate, is because once it's done, the value went up. Just like if you renovated a house, the value went up, and you can refinance off that new value, and you could pull out all of your initial investment. Now, if we talk about what initial investment looks like, so number one, like I said, you need to buy land. Now here's the secret, is you actually don't need to buy the land in cash. A lot of people don't know this. So let's say this house, for example, it's an empty piece of land, okay? And they want $500,000 for it. That's the price, $500,000. You don't need $500,000 in cash. All you need is 35% down to buy that piece of land, okay? So 35% of $500,000 is $175,000. Now you need to find $175,000. Now either if it's in your savings, or if you have a business, you're making money there, or you have investors, right? So you buy it, boom, 175. Now obviously there's closing costs, there's lawyer fees, etc. Add in another $5,000. Now on top of that, we need to show equity on this land before they give us a term sheet at the bank for construction financing. So meaning the banks will not back this project if it's just dirt. They want to see some action, they want to see some equity on it, right? It makes sense. And so what you want to do is you want to at least, now it depends on the bank. Some banks want to see lockup. Some banks are okay with up to just foundation. So let's say foundation they're okay with. So you need to take it to foundation. What does that mean? Normally it costs around $200,000 to $250,000 to get to foundation. Now that is cash that you need to find as well, okay? So to make the math easy, let's say it's $200,000 to get to foundation, plus the $175,000 you spent on the down payment on the land, you're at $375,000, okay? Now you need another $50,000 just to make sure you can carry the cost of the land, right? Because you financed it, so you need to carry that until the first draw. When the first draw comes in from the construction, from the bank, they pay out that bridge loan. It's called a bridge loan because you're just bridging, you're buying the land just to bridge it to get to the first draw. So So what is that? That's like 400 grand, 420, right? So that's the kind of cash that you need to be able to develop. Okay, now when you've spent that money, that's enough equity to show to the banks that, hey, this guy has enough equity in this project. We're gonna fund you, and you're gonna get a term sheet and start financing the project. Okay, now if we go back to what it looks like in terms of what during construction, you don't need, so obviously there is construction interest on the draws. Okay, so the draws come in, normally you have around 5 draws. Okay, so these draws come in after you finish certain milestones. I'm gonna take a seat here. So once you finish the foundation, you get the first draw. Next, you finish the framing, that's called the lockup stage, you get another draw. MEPs, you finish that, another draw, finishes, another draw. And then at the occupancy permit, once the city council deems it to be, livable, then you get the last draw. So every time you get these draws, there is a quantity surveyor involved. So these guys are a third party. They come to the site to make sure that your contractor that you hired did the job correctly. And then that's when they approve the draw. So the draw actually goes to your bank account, okay? Because it's your construction project. You're the developer. So the draw comes into you. So for example, let's say your contractor finished the framing, okay? They give you an invoice of 350,000, okay? They finished it, they give you the invoice, 350. That 350 you give to the bank, okay? Now the bank will send their QS, quantity surveyor, to the site, make sure it's done correctly. If it is good, then they wire that 350 to your account, and then it's your responsibility to pay your contractor, okay? Now again, remember, don't forget, you are entitled to developer fees. So during those draws, you actually have your own built-in developer fee in there. Again, like I said, normally it's around 100K for this kind of project that I'm talking about. For a $2 million project, which is normally what I do. So 100K divided by 5 draws. So normally you get around 20K every draw. Okay, so that's pretty cool. You get cash flow during the build. It's not even finished, but you're making money. Now, when the draws come in, you pay your contractor, like I mentioned, and then they keep doing the work as it progresses. Okay, so that's how that works. Again, there's more nuances to it, but that's basically the gist. Now, another reason why I say development is actually one of the safest things, guys, is because you have 4 different parties checking the workmanship of your construction. So number 1 is your actual contractor. They have their own in-house project management team. So obviously they're gonna check, make sure the work is job done correctly. Why? Because there is warranties. So your builder, your contractor, they should be giving you warranties on their work, and their subcontractors also have warranties. So you have 2 layers of warranties. If they do the job wrong, they have to come back and fix it. That's pretty annoying for them. So they want to do it correctly the first time, okay? So that's number 1. The contractor has their own on-site inspectors in-house. Number 2 is your own third-party inspector. So you can hire your own inspector, right? And they can check, make sure the job is done correctly. Number 3, the city. The city comes, inspects the work of your contractor, make sure it's done correctly to the city standard. Now, of course, no one's perfect. Some of these guys miss stuff all the time, but it's a good set of eyes, and they're free. And they check, make sure it's done correctly, and they put stamps and stickers to make sure it's passed, or if it's wrong, they put a red sticker. Your contractor has to do it again. Number 4, the QS, the quantity surveyor. That is from the bank. The bank that gives you these draws, they also come to on the site and check, make sure it was done correctly. Okay, and number 5, of course, you yourself, you can go on site. So as you can see, there's 4 or 5 different people coming with different set of eyes, different set of interests involved in the project to make sure it's done correctly. So that's why it's super safe. Again, when I say 2026 is a year that a lot of wealth is going to be created, is not through getting lucky on the next Bitcoin. It's not through inventing a random scooter. That's really cool. I mean, you could do that, but for the general public, for the everyday investor, again, you do need quite a bit of cash, but if you know how the game works, you can easily raise the cash and pool together a bunch of investors to do your first development. And once it's done, you pull out the money via the refinance anyways. Okay, so this is the most accessible way for any investor to get 100% returns in less than a year. And obviously I'm not making any claims, so don't call your lawyers. But what I'm saying is, normally when you develop, the value goes up. The value always goes up once it's done, normally around $500,000 for my kind of projects. And then once the value is higher, you pull out that money via a refinance, okay? Via the term loan. Okay, so let's talk about this. So the construction loan is just a construction loan, okay? There is what's called the takeout loan or the term loan. So that loan, that's the permanent loan that takes out the construction loan. So that's more of a, it's a permanent loan. So basically, in my case, it's a 50-year amortization. I know the states also rolled out their own 50-year amortization. So lower payments per month, 50-year amortization, or you could choose 35-year, it doesn't matter. But really the point is, if you develop from scratch, then your cost, okay, you can afford to pay more in monthly payments because you built it at cost, right? So for example, if you build, let's say multifamily, just, decent finishes, quartz countertop, like I mentioned, soft close cabinet, you're looking at around, it depends where you are, but 200 to 250 a square foot, okay, to build, and then land on top of that. So what I'm saying is, on average over here, or in Canada, it's around 1.9 million all in to build 8 units, okay, 7,500 square feet ish. Now, and that's with the land, that's with the interest cost, everything. If you buy it on the market from people like me, once we built it, you could buy it for like 2.3, right, 2.4, and so you could see the profit that we're making by doing this. And so that's why, instead of buying it on the market where you're making, someone like me, $500,000 profit, you should just build it yourself, become the developer, build it from scratch. And guess what, if that's just one project, if you do 2, that's $1 million profit. Okay, we're talking about profit, net profit in your pocket. This is not revenue, we're talking profit. And so it's very important to recognize that, because you can build 2 projects and become a millionaire while traveling. Okay, you can literally just travel, because why? You have a project manager on site who is taking care of the project for you, right? So it's pretty cool. It's very accessible to anyone. All you need to know is, locations. Like, you need to understand, you need to buy it in the correct locations. Make sure you're not buying in bad locations, obviously. That's really the name of the game of real estate. And it's very, very fun, super fun to buy land, do the architecture drawings, and then build. Now, let's talk about the process of pre-construction before we actually build, okay? So it's very nuanced, but I'm giving you a master class here in this video. So if you like this, hit the like. If you're still here watching this, comment down below where you're from. So this is how it works, okay? When you buy the land, boom. Now, let's assume there's a house on it, okay? Buy the land, there's still a house. There's still a tenant. Now, you have to give notice to the tenant so that they can, leave. They gotta leave before you demolish the house. So when you do that, you can do some work in the meantime. What can you do? You can do the drawings, okay? That's the first step, the architecture drawings. So when you do your drawings, that's not that's not it. Like, once you do the drawings, there's still a bunch of other steps before you can submit the package to the city. Okay, so where I'm from, once you finish the drawings, okay, and that's a full set of drawings: the elevation, the side elevation, front elevation, the blueprints, the foundation plan, the basement, etc., all that stuff. Okay, once that's done, now that normally takes around 3 weeks ish, depends on how much back and forth you go with your designer. Once that's done, and to submit to an architect. Okay, well, actually, first you need the plot plan. Okay, so plot plan stakes out the plot, and then after that you do what's called the engineering drawings. And so on top of the drawings that you guys did, the engineers will stake out, and on top of the design that you just did, they're gonna design the roof, the trusses, and the foundation more in depth, more in detail. Okay, and you need to do that to have a full set of drawings. Now, on top of that, the plot plan, like I mentioned, and then the lot grading. Okay, so the lot grading as well, you need to do. It's a study of the grading to make sure, it doesn't, if it floods, etc. It's just the grading is good. I don't know, I'm not an expert in that, but I just pay the people to do it, and they do it, and they do a good job. Everything I just mentioned depends on the lead time. So these are different departments. Okay, the lot grading, the plot plan, the engineering, and then the designer, all these guys are different. And so these guys might be super busy with other clients, so it might take 3 weeks each of them just to accept your project. So it takes time. So that's the thing, right? So we're talking about almost 2.5 months just for the full set of drawings. Now, while you're doing this, you can also apply to finally demolish the house. Before you demolish the house, you have to disconnect the water, gas, and electricity. Okay, so when you disconnect these things, you have to call the city or whoever's in charge of. So in my case, it's EPCOR. They have a monopoly on the water, so I have to call them. Now, if they have a monopoly, guess what? They don't care. So they take their sweet time. And I actually have an instance where one project, it took 3 months just for them to find the main shut-off valve. Okay, it's called the CC. It took them 3 months to find it. It took 1 month to schedule them to come. When they came, they couldn't find it, so they would rebook. Month 2, they came in, they brought the right equipment because they didn't have the right metal detector or whatever. They came, they still couldn't find it, rebooked me for month 3. 3 months just to shut off the main water. Okay, super annoying. And they actually broke a pipe, and they gave me a bill of $4,000 because it broke. I told them, how is this my fault? Anyways, I got that refunded. So after that, you need to call the gas company, electricity, gas, water, electricity, so they could take out the meters. Okay, take out the meters. That takes time too. So everything I mentioned so far, how long has this been now? Like 3 months, 3.5 ish, and you still haven't gotten demo permit. Once you have these, then you can finally submit for demolition permits. Now, demolition permits, that takes 2 to 4 weeks. Okay, it depends, sometimes 6. So once you get the demolition permit, finally, hallelujah, now you can demolish the house. And once you've demolished the house, you could also submit for development permit, okay, which states that you can finally develop on the land. Okay, so all of these, like I mentioned, that took 4 months just to get to apply for development permit. Technically, you could apply for development permit in the beginning, but they still need some more documents in the meantime. So anyways, the whole process, like I mentioned, takes 6-8 months to get the permits. And then once you get the permits, after 8 months of waiting, doing all this work, then you can finally build. And build should take you about 8 to 10 months. That's my speed anyways. And so, as you can see, guys, lots of work, but there are professionals that do this on your behalf, and all you do is manage it, oversee, and then you get to learn exactly how they do it. So is it worth it? I mean, if making 6 figures is worth it to you within a year and a half, now again, one trick for you to take this timeline down is to buy permit ready land, which I have a bunch of off-market permit ready land, so it saves us 8 months so that we could just start digging. Okay, now a bunch of other times that takes a lot of time is the financing. Okay, so it depends on how scattered your documents are, because they are going to need a bunch of documents like your your taxes, your notice of assessment, a bunch of bank statements, etc. If you're slow in giving these to your broker, it's going to slow down the file, and it takes them time to give you your term sheet as well, and for the funding as well. Okay, so that takes time as well. But again, if you're organized, it should be done fast. Now again, is this worth it? If you want to create 6 figures of profit or net worth within a year, and then pull it out, so you could do another one like what I'm doing, then yes, it is very much so worth it. And if you want to be able to be free with your time, you want to spend time just traveling, spend time with family, going to restaurants, whatever you like, you can do that with this business, because it's super hands off. It's just a lot of documents, a lot of following up, a lot of babysitting, but you could always hire oh, it's snowing. A project manager for your project manager, like an assistant. Okay, so super cool, guys. Let me know what I should do in this area. Just visiting some friends for a wedding. But anyways, that's how you create wealth for 2026. Again, real estate is, people always need a place to live, but also if you create beautiful brand new spaces, you're going to basically you're competing against the older 1980, 1950 houses, right? So inherently, if you're a tenant, do you want to live in the old 1950s, or do you want to spend a little bit more in rent and then live in a brand new? Of course you want to live in brand new. Now in terms of your returns, like I mentioned, you can pull out your money once it's done via refinance, meaning you'll have $0. Sometimes you'll even pull out more money on top of what you invested. If you listen to this video in full, you know that we talked about you need around 400,000, around there. You could pull out all of that plus more, so you have actually a gain on the project. Plus, if you're keeping it, I suggest you do, because when you pull out the money, it's tax free. Okay, so instead of selling it, because let's say you do sell it, let's say you built it for 1.9, you want to sell it at 2.3 million. Okay, so that's 400k. But remember, number one, you pay capital gains tax. Okay, so you're taxed on that. Number two, you're paying realtor fees. Okay, realtors charge like 3%. So why not just keep it? Because when you keep it, when you refinance, you keep that entire bag, that half 400,000 plus a little bit more, tax free. So you could take that money and build another one. Okay, so that's what you should do. And so with that being said, that's how this business is super scalable. And again, we're just talking about 8 units. If we build 80 units or 100 units, right? Now we're talking about multi-million dollar profits in just one project, right? So imagine if you do 2, 3, etc. at the same time. So that's how you recycle your money, make it grow, make it work for you, so that you can get wealthy in a short amount of time. I always say real estate makes you wealthy for sure, but development makes you wealthy fast. So if you want to get wealthy in 20 years, just buy existing 4plex or 20 units. Just buy that and then cash flow, and then wait 10-20 years, you'll get wealthy. But if you want to get wealthy quick, you want to get wealthy young, buy a piece of land, demolish the old structure, and then develop, because development is how you create massive equity. And you could choose to either pull it out via refinance or sell it for a profit, again, you should just refinance. And this is a skill you can take anywhere. Development, you can, once you learn the skill, you can develop anything you want. You can develop a restaurant, you can develop hotels, you can develop wedding venues. I was just at Disneyland with the family, and I was Googling how much it cost to develop the whole thing. I believe it was like $250 million back in the 1980s or whatever. And now it's worth, obviously billions. And so you can see the wealth that they created from developing it from scratch, and the developer fees that they had while they built it. So when they built it with that $250 million, $250 million to build Disneyland, California, and that $250 million, you bet that they had their own developer fees in there. It's probably like 10 million or 15 million. So the developer got paid while building generational wealth project. So guys, that's kind of how it works. If this video helped, I hope it did. Hit the like, leave some comments down below, and stay tuned for more educational videos about creating wealth through development.